Welcome to Capital Gains, Yahoo Finance's unique look at how U.S. government policy will affect your bottom line. I'm your host, Rachelle Akuffo, and of course, we're going to be looking at this final home stretch for the Biden administration as President-elect Trump readies for office, and we're going to be talking all things energy, clean energy, green energy, drill baby drill energy, and of course, what all of this means under the purview of Trump 2.0. And of course, later on, we're also going to be joined by Faculty Director of the Penn Wharton Budget Model, Kent Smetters, to really break down some of these numbers and some of these projections as to how these policies are going to impact the budget. And of course, we'll be talking all things Doge as well. But first, I have to bring in my co-stars, Akiko, Fujita, and Rick Newman, for their take on what they've been watching and what we can expect. Akiko, take it away. What are you watching?
So Rachelle and Rick, I came armed with props. You ready for this?
You have Ben's note cards. They're bigger than Ben's.
So I know Ben usually has note cards, but I came with supersized Post-its, okay? So here's the key word, tariffs.
That's budget friendly.
Which I know you've been talking about, but we got this. And that is the message. I've been talking to a lot of logistics companies this week. Yes, this ongoing conversation about what President Trump's or President-elect Trump's potential tariffs on Chinese imports coming in from Mexico and Canada, all imports, what all of that means. And there's been a number of headlines that some would argue have kind of added to, or at least been a little more alarmist, I would say, saying everybody is stockpiling, there's a surge at the ports. But the logistics companies I've been speaking to say there's a bit of dusting off of the 2018 playbook. In other words, people are a little more calm this time around because they've been here before with President Trump's initial tariffs, the China-U.S. trade war back in 2018. Rick, I know you've been looking at this too, but here's what's kind of interesting to me as I sort of been talking to these companies about how they're prepping for any potential tax on imports coming in. And that is to see how much the supply chain globally has shifted since 2018. Remember, at that time, it was all about imports coming in from China. Yes, they were a little more targeted, but that led to a lot of companies reassessing where their supply chains are. And then you had COVID, which only accelerated that move away or diversification away from China. And here's a number that kind of stood out to me as I was reporting this out. Goldman Sachs put out some data on where U.S.-China trade stands today. China's share of U.S. imports amounts to a 20-year low today of 13.5%, down from 20% in 2017. So does that mean that there won't be a significant impact? Absolutely not. There are companies that are very, very concerned about the potential for these tariffs. But there's also this realization of they kind of have an idea of how things played out last time, and they're sort of banking on that being the case this time around.
Well, let's remind people how things played out last time. Just to take China as one example. So when Trump was running for president in 2016, he said that he might consider tariffs on Chinese imports as high as 45%. So what did Trump actually do? He absolutely did not do 45% tariffs. What he did was tariffs ranging from 7.5% to 25%, and that was only on about half of all imports from China. And there was a very detectable pattern there. Trump put tariffs mostly on components and industrial goods and things ordinary consumers never see. He did not put new tariffs on toasters or on socks or clothing or televisions, stuff like that, for the most part. There were a few exceptions, but for the most part, he didn't. And so he buried the tariffs. Ordinary people did not see the tariffs, and I think that is what a lot of people are expecting this time around, too. So I think the reporting you're doing, Akiko, with importers and logistics companies, I think that reflects what we're seeing in the market. The market does not seem very concerned by Trump's tariffs, even though these would be distinctly negative for stocks and I think for other risk assets if he actually did what he says he's going to do. I think what the markets are saying is Trump is not going to do what he says he's going to do. He's really angry when he talks about tariffs, but then when it comes to imposing them, he's kind of like, maybe 10%, maybe 12%. So I think that a lot of this is bluff. I think he's bluffing on a lot of tariffs, and the markets are sussing that out.
This is exactly the point. I was speaking to an importer yesterday who said, Trump's just going to be Trump. This is part of a negotiating tool. There is one other change here, though, from 2018. which is the Chinese economy, right? Things are not as good as they were back then. And these companies on the U.S. end who are negotiating prices with suppliers in China feel like they have a little more leverage. So those conversations are already happening. And the thinking is that you talk about the targeted tariffs that happened under Trump first administration. He has, at least on the campaign trail, talked about more blanket tariffs coming in from China. If that is the case, and if that he actually keeps his word, then the thinking is, if I am company A and I'm competing against company B, they're still going to be in the same position. So what is the competitive advantage to stockpiling and leasing out more warehouse space when everybody's going to be in the same boat?
Well, I mean, we should point out that what Trump wants these companies to do is he doesn't want them to move their supply chain from China to Vietnam, which is what a lot of them did the first time around because Vietnam wasn't subject to the same tariffs. I mean, if you look at the import flows from 2018 and 2019, huge boom in stuff coming here from Vietnam while stuff coming from China trickled off. That was just Chinese stuff, mostly like being transshipped through Vietnam. I think that's why Trump is now saying universal baseline tariff. But you know what? One thing, he has not really said anything about a tariff on Chinese imports yet. I think he's going to, but all he said really is Canada and Mexico. So, people figured this out and a little less stringent this time around.
I mean, he did say he was going to add that additional 10%. But I mean, even he was named Time Magazine's Person of the Year. But even in that interview, when they were trying to dig in to some of the specifics, most of the answers were, it depends. Now, it was interesting because he did say that one of his priorities starting out, other than immigration, so obviously one of these populist topics, was oil and drilling, getting more drilling. So I want to talk quickly about some of his energy policies and some of the companies like Exxon, surprisingly, who are actually in the sweet spot here. Akiko, I know you've been following this story as well, especially as we look at the amount of electricity that generative AI and data centers are going to make. You would think Trump is anti-clean energy, but that doesn't really seem to be the case.
Yeah, and I would say, Rick put out a good report on this week. I want to start by just talking about where things are, because I think there's a misconception here that, Trump is suddenly going to unleash all this oil drilling. I remind everybody that's listening that under current President Biden, U.S. oil and gas production reached record levels. And that's sort of been the challenge, right? With the Biden administration wanting to be all about climate, but also really turning up the notch here in terms of oil production. It's the opposite in some ways, right? Rick, when you talk about the Trump administration, he wants the message to be drill, baby, drill. I'm going to leach all this oil. The reality is you've got all these fossil fuel companies who are saying, well, wait a second, the IRA has actually been good for us, the Inflation Reduction Act and the tax incentives that have been in there. We want those incentives to continue investing in technology like carbon capture that we think down the line will be a big revenue driver moving forward.
Yeah, a couple things there, Akiko. Drill, baby, drill means produce more oil, which means prices go down, which means profits go down. I think Exxon and Chevron and Oxy and the big U.S. oil firms, I think they're pretty comfortable where prices are and supply are right now. I mean, we've got oil in the $60 to $70 range. They're making good money, and they're not facing the criticism that they have in the past about ripping off consumers because gas prices are too high. So they like it where it is. They don't want to produce all that much more oil. They are certainly going to like Trump's deregulatory moves. It's going to make it easier for them to do business. So that's what Trump's going to get on fossil fuels. And I guarantee you that Trump is going to say, regardless of what the facts are at some point early in his presidency, look, I've unleashed all this oil and natural gas drilling. Well, I did it. I said we were going to drill, baby, drill, and we're doing it. So maybe that's how Trump defines success. On green energy, this is complicated, many moving parts, but this now has momentum that goes beyond incentives from any government in the world, including the U.S. government. Sure, those help. And Trump could repeal some of those incentives, especially most likely the ones for people who buy electric cars. But this is an industry of the future, and it's a huge industry of the future. There's a ton of money going into green energy. Globally, there's more money going into green energy than is going into fossil fuels. And if Trump changes the policies, that'll change a little. But this train has left the station, And this is a huge market that's going to continue for the most part. And I think that is part of the reason that Trump is probably not going to change very much. I think he's going to have a hard time changing this stuff because businesses are going to be coming to him saying, hey, man, there's a lot of money here. Why are you doing this?
Rick, I was thinking about this conversation that we had very early on in the Biden administration with Energy Secretary Jennifer Granholm, who said essentially, we want to set up a marketplace where it's the market that dictates the move and this push to clean energy. And to your point, in many ways, that's where the market is moving, right? If you think about the IRA incentives, which is, of course, the largest climate bill that's been passed in U.S. history, 75% of that funding went towards red states. They have seen the benefits and the job creation that's come out of it. And what was interesting to me, even before the Trump win, there were 18 lawmakers, Republican lawmakers, who went to the House Speaker, Mike Johnson, and said, look, regardless of what happens, don't move to repeal the IRA wholeheartedly. So it is, as you say, we talk about clean energy. It's such a big topic. There's many, many verticals here that they can tackle. Nobody expects the IRA to stay as it is, but in many ways, they've seen the benefits, they as in the Republicans, and, probably going to have a hard time going to some of these red states and saying we're going to pull back that money because it's been an economic boom.
Yeah, they're not going to pull back the
like
money.
Georgia.
They're just not going to pull it back.
Yeah. I mean, that's where the jobs and the investments are headed. So, it'd be like a roach wanting raid. I mean, no, this is voting against your best interest, but we'll see how that plays out. We do have to take a quick break, but we'll be digging in more to the Trump 2.0 economy and, of course, those budget cuts on the other side of this break with Kent Smetters and more capital gains.
Welcome back to Capital Gains. We are now going to be talking about slashing government spending, a big focus for President-elect Donald Trump. And to talk about that, we've got Kent Smetters. He's the faculty director at the Penn Wharton Budget Model. And Kent, you have put forward a package of 13 major tax and spending reforms. This, of course, getting a lot of attention because of DOGE, the Department of Government Efficiency. Let's kind of start high level here because we do know the number that the president-elect, or at least Elon Musk and Vivek Ramaswamy, are targeting $500 billion a year in cuts from government spending. What does your analysis tell you about where potential targets can be?
Right. It's going to be challenging to get that purely from so-called efficiency. There's going to have to be some real spending cuts if that is going to be the target. And so what we are analyzing in these 13 different reforms is, showing that you can do sizable debt reduction while actually growing the economy and also protecting low-income households, in fact, making them even better off over time with economic growth. But the timing is important. You need to get revenue in first, and then the spending cuts are more like simply slowly increasing things like the normal retirement age for Social Security and Medicare. So in the case of Social Security, nobody below age 50 above age 50 would be hit by it at all. But even below age 50, the change in retirement age from 67 to 70 in this plan would happen over decades. It wouldn't be phased in until the 2070s. And so the idea is we still have some time available to control spending growth, but then we need some money up front.
So I follow the Penn Wharton budget model. I use your data in my reporting all the time. And when I went through this, I noticed you really don't have anything about cutting foreign aid, cutting arts funding, and some of the things you hear some of the budget hawks talk about. I think I know the reason. The reason is that that amount of spending is puny. Is that the reason that it's not in here and you're focusing on other stuff?
That's right. And in particular, the approach here is not a political approach. It really is basically saying, let's think about almost like first principles in economics. And in particular, if we took more left-leaning economists, more right-leaning economists, but still within one standard deviation, say from the middle, no kind of extremes.
Yeah.
What is the generally agreed upon principles that of economics in terms of why does the government spend? Why does it spend money on certain things? How does it tax in an efficient way that promotes growth while also balancing, protection for low income? And so we haven't looked at some of the more politically sensitive topics because we're not taking a position in the arts and things like 4 and 8. But as you point out, they would be in the rounding error in all of this.
Right.
They're incredibly small.
Okay, so I always tell people, like, you can go and look at this analysis, and I encourage everybody to do that. Go to the Penn Wharton budget model. Last time I looked, it was right on your homepage. This report is 17 pages. You can get the idea. And I mean, the big takeaway when you look at here's what it would take. I mean, you're highlighting that it's the big programs. And when you talk about spending cuts, you don't really have anything discretionary, roads and bridges and stuff like that. It's healthcare, Medicare, and to some extent, it's Social Security. It's reforms in those programs. So why don't you just outline the nature of the types of reforms we would actually need in order to reach some of these targets?
Sure. So certainly we're going to have some tax changes up front, but some of that is actually lowering the marginal tax rates to promote growth, but at the same time expanding the tax base, so getting rid of a lot of reductions and deductions and adjustments, including the ability to adjust your income for health care that you get through the employer. A lot of these various deductions, and so it's a very broad base that becomes taxed, but at a lower rate. In the case of spending programs, it's the main changes would be allowing the normal retirement age to keep pace with longevity in the population over time. Age 70 may sound like a lot, but it's not going to sound like a lot several decades from now as a normal retirement age. And the thing to keep in mind here is that even though people may say, well, these are technically cuts and so forth, well, that's only relative to not making these adjustments, and we're dramatically paying down debt. Actually, this set of policies would guarantee that people in retirement stay out of poverty, which is actually not guaranteed under current law. And furthermore, in healthcare, it actually would close the gap of the uninsured. There's about 10% of the population is currently uninsured in healthcare. We're projecting that's going to grow to 20% over the next several decades. This will actually reduce the uninsured rate to less than 1%. And so, and that's without socialized medicine or anything like that. So it really is about, in fact, healthcare premiums will go down by about 27% under these projections. And so I think it is one of those, it's basically dealing with the big point that you can do serious debt reduction without collapsing the economy. In fact, just the opposite. We grow GDP by over 20% over time, and you can actually help low-income people instead of harming them in the process.
All right, so here's an interesting takeaway here. And sort of in your conclusion, you say the largest revenue raiser in your plan is a comprehensive immigration reform, which doubles the number of illegal immigrants who will be subject to taxation. And also you say that for this to work, any immigrants coming into the country would have to purchase health insurance without a government subsidy. What's going on there?
Yeah, definitely not doubling illegal immigrants. It's actually just doubling over time. Legal immigrants is about 800,000 net new immigrants per year. It's a pretty small number. That has not actually been adjusted over a pretty long time. So this would just get us back to the rates that we would have been had we grown that immigration rate with the rest of the size of the population. But what's changed the last few years is that the U.S. population is no longer replacing itself. It's declining over time without immigration. So immigration plays a couple key roles. One is that it's really going to have the younger people play a role in helping support some of these programs like Social Security and Medicare and so forth. But the second one is that a lot of people object to, like, even keep in mind, legal immigration is much smaller than the undocumented things that we're talking that often make the news of 11 million undocumented workers. But what often it gets criticized, even with legal immigration, is, hey, these guys just come in and they just suck off the healthcare system. And what we're basically saying here is that you can have a price of entry, and the price of entry is that when you come in, you have to buy healthcare, and that in fact means that you can't use the Medicaid system or any type of government support program, or your employer has to document that they bought healthcare. And so what this does is that it actually dramatically improves the risk pool, because you have younger, healthier people. They help bring down premiums, including for native-born workers. So it's not that the immigrants are now costing the healthcare system money. They're actually doing just the opposite. They're actually bringing down healthcare costs for non-immigrant population as well.
Elon Musk is obviously a celebrity in his own right. He's not the first one to try this. There are other administrations that have tried to go in and slash the spending there. Why is it so difficult?
Yeah, it's a great question. I mean,
what are the challenges as you try to crunch the numbers to get to the place that the budget needs to be?
Yeah, and some people have reacted to this and say, oh, it's just a big changes and so forth. It's unrealistic that we'll get this done. My response to that is our current path is what's unrealistic, because it's simply not sustainable. And capital markets are being a little patient right now, assuming Congress will get its act together, but it's going to require big changes. And so we're just in a dire situation right now on the current path. We don't have a long time before fixed income markets, bond markets, are going to realize that mortgage rates of 7%, it's actually too low. And so if we want to get borrowing rates down and so forth, the government needs to get its act together. And so this is, we have done big stuff in the past. It's just been a long time. The 1986 Tax Reform Act, both sides, Democrats, Republicans, acted like adults. They jumped off the bridge together and got it done. This is kind of like 1986 times 2. I mean, it's a much bigger shortfalls and problems that we face. And so we need real grown-ups to be able to do this. And people say, well, the political climate's not there. Well, we're showing you what needs to be fundamentally done. It doesn't have to be exactly this plan, but this is a response to many policymakers asking us, is it possible to actually cut debt while actually growing the economy? And the answer is yes. And in fact, also lift up low-income people in the process.
Kent, one last question, short amount of time here. You mentioned interest rates just a moment ago. Do you think interest rates are going to be the thing that is going to be the thing that somehow forces action here? And how high do interest rates have to go?
Yeah, that is going to be the forcing mechanisms. If the adults in the room don't act like adults, then the capital markets are going to discipline them, and that's going to be through interest rates. And so what we're suggesting right now is that I can imagine mortgage rates go down a little bit in the next year or two. We're definitely not going back from 7 to 3%. At the same time, 7% would cause some pain. 9% double digit. I think that is where maybe interest rates have to go before politicians do respond. But it is going to be very challenging on younger people trying to buy a house going forward if these interest rates don't come down. And if they don't do anything, we're projecting that interest rates literally have to go above 15% within a decade if we just keep on this current path. And so that is it's a serious challenge.
15% interest rates will get everybody's attention.
That's right.
Ken, I was just going to say, I applaud you for doing the hard work. I cannot imagine the data that you had to go through to crunch all this, but thank you so much for joining us today. Kent Smetter is faculty director over at Penn Wharton Budget Model.
Thank you, Kent.
That's all for this episode of Capital Gains. Thank you all for joining. Thank you, Rick, as always. Thank you for joining us. Make sure to like and subscribe to Capital Gains wherever you get your podcasts. Until then, we'll see you next time on Yahoo Finance.